You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Hello, and a warm welcome to our latest PMI podcast from Global Intelligence and Analytics at S&P Global. I'm Paul Smith, the director in the team that produces the PMI figures, and today I'm joined by two fellow economists, our regular contributor Andrew Harker, and making what for us is a record third guest appearance in our rotating chair, Joe Hayes. Welcome to you both today.
Thanks, Paul. Good to be back on the podcast in 2023.
Yeah, thank you, Paul. Delighted to have the record.
Yep, good. It's very nice to hold such esteemed records in, of course. You're both very welcome and really looking forward to getting your insight and expertise today. Now, in today's podcast, Joe and Andrew, with a little help from myself, are going to use the prism of our PMI datasets to look at several of the most important themes in the global economy at the start of 2023. These include inflation, the recent reopening of China's economy, and supply chain risks. Now, we also continue to see tighter monetary policy around the world at the start of 2023. And a week or so ago, we saw the Federal Reserve, Bank of England and the ECB all continue to tighten monetary policy at the first meetings of the year. Now, Joe, you work on our Eurozone PMIs, and it'd be just a good thing if you could just give us an insight into what you've maybe seen on the inflation front and what may have prompted the ECB to continue to tighten policy.
Yeah, definitely, Paul. So I think first and foremost, it's good to remind listeners that we track two measures of inflation. So not only do we track input cost inflation, so the prices that companies are paying, but we also track output price inflation, which is the prices that firms are charging. And what we saw in the January surveys is we saw the composite input prices PMI for the Eurozone fall to its lowest level since April 2021. So that shows us that input cost inflation has eased quite significantly from its peaks. But in terms of what was probably the most interesting thing, Paul, if you look beneath the composite data and look at the sector level stuff, I think there's quite an interesting divergence we're seeing opening up between the manufacturing and services surveys. So in manufacturing, and this links into the easing of supply chain pressures that we've seen and the weakening of demand there, but cost inflation has eased a lot and it's now below its historical average, which is quite a remarkable turnaround really when you think where we were kind of a year ago, which contrasts quite significantly with the services sector. But actually staying on the manufacturing sector and looking at our other measure of inflation, output prices, even though we've seen input cost inflation drop quite a lot for manufacturers, what we saw this month was we saw output price inflation actually quicken slightly. And actually overall, we're now in a position where our output prices indicator for manufacturing is above our input cost indicator. And I think what's striking about this is this has only happened 5 months out of over 20 years of data collection, and we've now seen it in back-to-back months. So bringing this all together, what does this actually mean? I think it shows that company pricing power is actually quite strong, and especially in the manufacturing sector where, according to our surveys, we've seen the downturn be a lot more faster and sharper. And that does come as quite a surprise to see that quite strong pricing power. And I think if this trend continues, it will probably be a worry for the policymakers and the ECB.
Yeah, that's something similar, isn't it, across quite a few countries of the Eurozone. I saw that in Italy, a country I cover here in the team. Cost inflation, especially in manufacturing, continuing to tumble. Probably an energy cost kind of impact, or the lessening impact of energy costs. And I think as you kind of hinted, that supply chains are a little bit more balanced than they were, partly driven by falling demand. But yeah, likewise in Italy, output prices generally rising at a faster rate than costs. So not quite the same picture though, is it, in services? There's not that inversion, if you like. So costs are rising at a slower rate in services, but charges yet to catch completely up with input costs. So like you say, I think there's that desire, isn't there, to claw back some margin amongst corporates at the moment. So
definitely.
And probably something that people are maybe not quite as aware of, especially when we've got tighter labour markets as well, driving up wage pressures. But I think that's something that we'll come on to later, of course. So And Joe, you've been waiting patiently there. And I think Joe's already taken your slot of stat of the month with that 5 months in 20 years, to be quite honest with you there. But for you, I think this month, another key theme, the start of the year was Mainland China. Obviously, everyone knows it was kind of, shut down for COVID for a lot of 2022. A lot of restrictions really went into a reopening phase towards the end of last year and probably continued into the start of this year. You've been taking a look at the PMI data for us. Maybe you could give us a quick overview of what's going on there.
Absolutely, Paul. Yes, you're right. Mainland China's moving away from that COVID policy. And I guess the PMI data is one of the first indicators that's out there to show what impact that's having on the economy at the start of the year. And what we've seen, I guess, is kind of what we'd have hoped and expected to see in January. So the economy returned to growth, and that was largely driven by the service sector, which again sort of matches up with what we've seen in other parts of the world when economies have moved out of COVID restrictions. That service sector rebound has been what's driven it. And so that was positive month really for Mainland China to see that coming back above 50. And actually, if you look at business confidence, that was joint highest in about a decade. So there's real optimism amongst firms there that this rebound can be sustained into the future. And that has positive implications for other economies. Obviously, globally, that's great news if Mainland China's back operating on full throttle. And I guess you can see that immediately if you look at an economy like Hong Kong SAR, that saw improvement in new business in January for the first time in a while, and actually a rise in new orders from Mainland China, which is one of the indexes we have on the Hong Kong SAR survey. And that index has only showed growth twice now since the start of the pandemic. So quite something really to see that immediate impact in that economy, and hopefully that will be replicated in others.
Yeah, I think that's going to be the key, isn't it? Whether it has a wider regional impact, which you kind of expect it's going to. And I guess one thing that we hinted about there in our kind of opening couple of segments was about supply chains, and that China's reopening does have some positive implications, I think, for supply chains, which I think during the pandemic especially were a huge source of productive constraint and then inflationary pressures. We've been tracking, haven't we, the impact of supply chains primarily through an index that we call, our supplies delivery times index, principally from our manufacturing data, which incidentally, that supplies delivery times index was actually the favourite index of those of us who can remember the ex-chair of the Federal Reserve, Alan Greenspan. It was his favourite economic statistic, largely because of its timeliness. And of course, it gave him a steer on price pressures and how he could then think about getting ahead of the curve with changes in monetary policy. Now, I thought it'd be quite useful, Andrew, if you wouldn't mind just giving us a little bit more information on what that supplies delivery times index is and what it exactly is measuring.
Absolutely, yes. So when we're talking about the supplies delivery times index, what we're doing is we're asking companies to tell us how quickly they're receiving items that they've purchased from their suppliers. So similar with the other PMI questions, the respondents get 3 options. So suppliers delivery times could either have shortened, lengthened, or stayed the same. This can be for a variety of reasons, really. So normally you'd expect if an economy is growing quickly, there's a lot of demand within the sector. You might think the suppliers delivery times will be lengthening because there's a lot of capacity pressures there on the vendors. And so normally we treat it as a positive thing if suppliers delivery times are lengthening because it's traditionally thought of as being due to demand pressures. What we saw really during the pandemic and the aftermath of the pandemic, I guess won't surprise our regular listeners to hear that the supplies delivery times index hit records, quite big records as well, in terms of the amount of lengthening that was going on and disruption caused in supply chains. But if we sort of look at what the current situation is, it's quite a lot brighter than it was at that time. What we're seeing now is supplies delivery times lengthening to the least extent in about 3 years. And we're even seeing lead times shorten in a number of economies such as Germany, the US, India, Brazil. So definitely a much improved picture on what we've seen over the previous couple of years.
I think what's kind of interesting with all that is just looking at the index in isolation, you actually want to know a little bit more about the reasoning behind why something's changed and the complexity of why lead times are lengthening. Like you said, it can be positive in some respects, it could be a negative constraint like we saw during the pandemic. Now, I think this is where Joe might be able to help us out a little bit more. He's been going one step beyond, really, with the suppliers' delivery times, with some recent work he's been doing on supply conditions for an exciting new project that we've been working on towards the end of last year. Joe, could you give us a little bit more details on some of that project work?
Yeah, one step beyond indeed, Paul. As Andrew touched on there, typically the supplier's delivery times index, we'd look at it, and when lead times are lengthening, it can historically has been looked at a generally positive sign because it means there's a lot of demand, and it normally can be a sign of an overheating economy with excess demand. Like you said, referring to Alan Greenspan, it's a great leading indicator of price pressures. But I think what's been really vital in the last few years especially, and what will be vital going forward, is really understanding what is driving supply chains. And, in the PMI team, we're in a very privileged position because not only do we ask companies about what's going on, but we get to ask them why. And through that, we've been able to gather some really powerful insights. And I think you've had one of my colleagues on previously to discuss the panel comments data, which is really quantifying that why. But what we've done is we've aggregated numerous indicators, all derived from our PMI surveys, and we're able to track all the various factors which can impact supply chains. We're talking about demand side factors, we're talking about supply and shortages and item availability, we're talking about backlogs, transportation costs, inventories. So what we've done is we've brought all of this together, all of our PMI data in these areas, and we've worked in partnership with a consulting company in the supply chain space, GEP Worldwide, to develop the GEP Global Supply Chain Volatility Index.
Thanks, Joe. It'd be good if you can expand on a little bit more. You got any more details you could maybe give us on them factors that we're covering in that index?
Yeah, definitely. So our listeners will probably be very familiar with our manufacturing quantity of purchases index. So this one here, this is how we track demand for inputs. We're talking about commodities, companies need to provide their goods and services. All of these items obviously are going to be moving through supply chains, and that's a really important demand side factor to capture, just to see how purchasing activity is going to impact supply performance. But also we have some other indicators. We have our supply shortages indicators, which tracks the scarcity of, I believe it's 27 critical components, such as chemicals, base metals, semiconductors. And as well from that, we have our price pressure indicator for transportation costs. Again, transportation costs are critical to feeling where supply chains are. We saw transportation costs surge, obviously, after the pandemic, when there was intense pressure on shipping routes, container rates, and so on and so forth. And as well, talking about the panel comment stuff, we have some really great information where we're able to pin down what exactly is driving inventory decisions. And I think one which was absolutely critical to monitor throughout the pandemic was our reports of safety stockpiling. So this shows companies are obviously concerned about prices and supply, and it can be something which can become a bit of a self-fulfilling prophecy, where the more and more companies safety stockpile can lead to that panic buying, which many of us saw in the UK regarding toilet rolls, for example.
Thanks for reminding us of those days. What I really love about this index is just using the full gamut of data that we've got available to us, and then all wrapped up, of course, in one single index. But then you can really pull apart all the different components of the index. So just a couple more questions from me on this new work. I know we're very close to the release of our January data, so you can't go too much into that information, but maybe you could just give us a bit of an indication of what you were seeing with the December figures that were released in January.
Yeah, definitely, Paul. So in December, at the end of last year, we've seen that supply chain conditions have drastically improved since around the middle of 2020. We've seen a lot fewer reports of item shortages. We've seen that transportation costs have essentially normalised, and we're seeing really weak demand pressures, and all of these factors have taken strain away from suppliers. Interestingly, though, in the December survey, due to the relaxation of COVID restrictions in mainland China, we actually did see a slight uptick in reports of safety stockpiling, because I think companies were a bit concerned about what that could mean with soaring infection rates, what that could potentially mean for supply chains, whether there be any disruption there. So we did see a slight increase in supply chain volatility in December. So yeah, it'll be interesting to see what we release this month. It should be out not too long after this podcast is launched, hopefully.
I was going to ask when the next release is, but also how can I get hold of this data if I want the time series? You know how much I love a time series, Joe. So
yeah,
how can listeners get hold of this information?
So we'll always release a press release on our website if our listeners want to get a quick overview of the latest data. But if they're interested in receiving the full history, just drop us an email at economics@spglobal.com.
Fantastic. Thank you very much. So we're just about still, aren't we, at the start of 2023? We still got another 11 months ahead of us for the rest of the year. So I think we can just about get away with discussing some of what we feel are the most pertinent themes to look out for in our PMI data sets in 2023. So Joe, you have been very busy at the start of this year. So part of that new project that you've just been talking about, you've also been putting together, with the help of the team, of course, a top 10 themes to look out for in 2023 from the PMI data sets themselves. So could you give us a quick overview of what that top 10 is and what we're trying to get out of it?
Yeah, so I'm sure many of our listeners have probably had their inbox flooded with various top 10s, top 10 predictions, top 10s for 2023 from their various economic commentators. But we've decided to do our own little spin on it. We've published our top 10 PMI indicators, which we think are going to be quite important and interesting to monitor over the remainder of 2023. I think the results are pretty interesting, so I definitely would urge people to have a look at that.
I think you should give us a hint, Joe. What's your number one for the year to look out for out of that top 10?
I can't give you a number one, Paul. I love all 10 equally. But in terms of my favourite, I've been on the podcast before to talk about emerging markets. It's an area I find particularly interesting. But also I like to bring to the attention of our audience maybe some indicators that we have in our team that they might not necessarily be aware about. And one of them is our manufacturing output index for emerging markets, excluding mainland China. I think looking at just emerging markets on their own is interesting. And what's been quite remarkable actually is in the second half of last year, while developed markets and the global economy was not looking too great, recession risks were increasing, manufacturing sectors were really struggling, services was weakening. But actually looking at emerging markets, we saw quite a significant outperformance relative to their developed market peers. And that's in a world where we've had deteriorating trade, we've had higher interest rates in emerging markets, we've had a stronger US dollar, and all of these factors generally tend to weigh on emerging markets. So I'd be quite interested to see if this outperformance continues into 2023.
I'm going to pick one as well, if you don't mind, in response to you picking one, Joe. So I'm going to go for salary costs, again from our panel comments trackers, which I think, as we've mentioned throughout this podcast and towards the end of last year as well, something where we've been using our anecdotal evidence from the data sets to create new time series to see the relative commonality of factors that are driving PMI indexes. So I'm really looking for so-called second round impacts from what is quite a tight labour market. So second round impacts on inflation, of course. So I think it has the potential to keep inflation, particularly what we'd call core inflation, things outside of energy and food prices, erratic areas of inflation. And I think that has the potential to keep policy rates tighter for longer. So that's something I'm going to be looking at. Like I said, I think labour markets are quite tight. We saw non-farm payrolls last week coming in really strong in the US. So I think it really feeds into the narrative of wages having the potential to be quite high, or in terms of inflation, helping to drive that over the next year. So Andrew, I'm going to turn to you. You've been sat there patiently waiting for an opportunity again to say something. So what's your one out of this top 10 that you think is worth watching?
Thanks, Paul. Yeah, I'm glad actually no one's mentioned my one. I was getting a bit worried there for a second. My one, I guess, go back to what I was talking about towards the start of the episode, really. I'm going to be following what's happening in mainland China and keeping an eye out on that composite PMI output index to see really how much their reopening can help to boost activity in the region and also globally, because I think potentially if they have a good year, then that could make things a lot better globally as well.
Yeah, so I think we've got three pretty good ones there. Okay, as ever, I think we've covered a lot of ground in our 20 minutes or so. Lots of big themes here in the global economy, not just now, but to look out for in 2023. Inflation, supply chains, individual country performances. And again, I think it just highlights how useful the PMI data is in its timeliness and usefulness in understanding how the global economy is today and is evolving. So lots of insights can be gleaned from our PMI data set. So in the meantime, I think that's all that's left for me to say is my thanks as ever to Andrew and Joe for their contributions and insights this month. And please do keep up to date with our PMI data releases via the S&P Global website.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.